Hello everyone, I am Michael Ruger. I am the managing partner of Greenbush Financial Group. I learned something completely new this week for New York residents that inherit retirement accounts from someone who is over the age of 59 and a half when they passed away. So New York State has a special rule that if you take distributions from any type of pre-tax retirement account and you're over the age of 59 and a half, you do not have to pay tax each year on the first $20,000 that's distributed. Now, I knew about that. What I did not know about is if you are the beneficiary of someone's retirement account that passes away after 59 and a half, you as the beneficiary can inherit their $20,000 annual New York State tax exclusion when you're taking distributions from that retirement account as a beneficiary, even though you may not be 59 and a half. Now, if you are completely new to learning about inherited IRAs and you're in New York State, I would strongly recommend watching our other video, which talks about the inherited IRA rules, requirement of distributions, the new 10-year rule requirement, which beneficiaries are grandfathered into the stretch rule. I will put a link to that video in the description of this video below, but this video specifically is going to focus in on the New York State tax $20,000 exemption that can be inherited from someone that you are inheriting that IRA from. As I just mentioned, this video is going to focus on the state income tax rules, but just real quick on the federal rules. The federal rules are the same regardless of what state you live in. So if you inherit a retirement account and it goes into an inherited IRA, if you're under the age of 15 and a half, there's no 10% early withdrawal penalty when you take distributions because it's an inherited retirement account. And the second piece of this that's uniform is when you take distributions out of inherited retirement accounts, you have to pay taxation at the federal level. While the rules are the same at the federal level, depending on what state you live in, each state typically has different rules for how they tax distributions from retirement accounts, included inherited IRAs. So in New York State, we have a special rule that if you're over the age of 59 and a half, then you don't have to pay tax on the first $20,000 that comes out of a pre-tax retirement account each year. But as I mentioned in the intro, as a beneficiary of these retirement accounts, as long as the decedent passed away after obtaining age 59 and a half. That's key. So they have to obtain age 59 and a half. If they pass, then I, as the beneficiary of their retirement account, can then inherit their $20,000 per year exemption. If they happen to pass away before reaching age 59 and a half, that exemption is lost. Rule number 2 is the beneficiary of that retirement account must be a resident of New York State to take advantage of that $20,000 New York State tax exemption, which makes sense because if you have a beneficiary that's, say, a resident of Texas, they would never need a New York State tax deduction because they're not filing a tax return in New York State. There is also a special rule that pertains to individuals that have multiple beneficiaries listed on their retirement accounts, which is not uncommon at all. If, let's say, you have a father that lists their 2 children as primary beneficiaries in the account, and then the account is split 50-50 when the father passes away, each child does not receive a $20,000 New York State tax exemption, assuming both the kids are New York State residents. The way it works is they look at the $20,000 New York State exemption of the decedent, and it's split evenly amongst the number of beneficiaries that they have on their retirement account. So in that case, 2 children, they would each receive a $10,000 allocation of that deduction for any distributions taken out of that inherited retirement account each year. That then raises the question, what happens if you have beneficiaries, some that are in New York State and some that are in states outside of New York? So in that example where we had the 2 kids, let's say one lives in New York and the other one lives in Texas, and they split that deduction $20,000 each. Since there's only one in New York, do they get to keep the full $20,000 tax deduction? The answer is no. It is evenly split amongst a number of beneficiaries, regardless of where those beneficiaries live. So in that 50-50 split case, the child that lives in New York would be allocated $10,000 of that New York State tax deduction each year for when they take distributions from their inherited IRA. Now let's build again on that example and say, what happens if you have multiple retirement accounts and the beneficiaries are different on each account? So let's say we have a traditional IRA where one of the kids is 100% beneficiary, but then we have a 401k for that same decedent where there's the child and their 3 siblings. So now there's 4 beneficiaries over here. How do you go about splitting up that $20,000 exemption between those beneficiaries under the age of 59 and a half? it is split based on the total number of beneficiaries for all retirement accounts. So in this case, if there's a total of 4 beneficiaries, when you look at all the retirement accounts together, they would each get 25% of that $20,000 exemption each year, so $5,000 apiece. But what if you don't know who the other beneficiaries are on that retirement account, which happens all the time? A lot of times people get notified that, hey, you're entitled to the share of your uncle's 401k account, and you're entitled to, let's say, get $30,000, and here's all your distribution options. But you have no idea if you are the only beneficiary on the account, if there's 3 other beneficiaries, and normally the custodians will not disclose any of that information. They just say, here's your share. What do you want to do with it? So the question becomes, what do I do? And the answer to that is, that's an excellent question. I actually have no idea. A few quick notes to clarify about this $20,000 annual exemption. So as I just mentioned, it's an annual exemption, which means if you are the sole beneficiary of someone's, let's say, traditional IRA account, you get to use $20,000 each year shielded from New York State taxation. It's not a one-time thing. And also, they aggregate all your distributions together. So it's not like, hey, I've got 3 different traditional IRAs inherited. I get to shield $20,000 from each one. It's $20,000 per tax year for all pre-tax accounts like traditional IRAs, 401ks, private pensions, any type of other type of employer-sponsored plan. So for beneficiaries that are already over the age of 59 and a half, do they get both their own $20,000 New York State tax deduction from their own retirement accounts and then an additional $20,000 deduction that they inherited from the decedent? The answer is no. It's an aggregate limit. So once you've hit 59 and a half, you get $20,000 regardless of the source it comes from. Really, the gem in this whole thing is if you're under the age of 59 and a half, normally you wouldn't have that $20,000 New York State tax exemption available to you, but now you will if that decedent was over the age of 59 and a half when they passed away. For individuals that are receiving New York State pensions, it gets even better because the New York State pension amount that you receive does not count against your $20,000 exemption allowance for these distributions from your inherited or pre-tax retirement account. So you can receive, let's say you're 55, you retire from the state, you get $50,000 a year from New York State tax pension. You can receive that pension and then also take $20,000 per year from that inherited IRA account and not pay any state income tax. Knowing how this $20,000 New York State exemption works is pivotal because most non-spouse beneficiaries now are subject to that new 10-year rule, which means they have to take all the money out of this IRA within a 10-year period. And if you know you have, let's say, $10,000 or $20,000 per year that's New York State tax-free, you may end up working that into your distribution plan versus if, let's say, it's a $300,000 traditional IRA and you're only required to take small RMDs, and then at the end you take out all $300,000. Well, the first $20,000 out of $300 would be avoid New York State tax, but the other $280,000 you would have paid New York State tax on, where if instead you took $20,000 each year over that 10-year period, about $200,000 would have been shielded from state tax as opposed to paying state tax on a bulk of it. I hope this information was helpful. If you have any questions, please feel free to reach out to me at greenbushfinancial.com. Thank you.